For more, we're joined by Chris Grisanti, MAI Capital Management's Chief Equity Strategist. Thank you for coming in as well today. Before we dive into that, do you want to just talk about this idea of victory cuts and whether we can kind of sound the all clear now, as is widely expected for markets and with the Fed?
David used this phrase that I think is a terrific phrase, victory cuts, that we'll finally be able to cut. I just don't ever, in my 30 years in the market, ever remember a victory cut. The Fed raises, if things stay good like they are now, why cut? And then they cut sooner or later because they need to cut. So I don't ever remember a victory cut, and I don't think we're going to get one this time, which is why I think that the pundits looking for early cuts in 24, they're either right because something bad's happened, or I think more likely they're wrong because the economy stays strong and the Fed keeps rates because they can.
So there's a saying that you typically want to sell the last hike.
Right.
And that has not worked this time. Now, we have had a couple of other cycles where the S&P rallies 20-25% before the bear market, but you can just sense out there that the mood has shifted and people are just throwing out the bearish thesis.
Yes, for the moment, Kelly. And of course, that's when I would urge investors to be cautious once you start throwing out the bear thesis, because the better way to invest is to have both theses in your head at the same time and be cautious and wary that, the Fed doesn't want to repeat the mistakes of the 70s and will keep rates longer if unemployment stays benign.
One of my favorite little signs of, metrics, the fear and greed index. We're in extreme greed territory. We're coming on. We're at 77 today. We're on a 7-week win streak. It all looks like clear sailing, but we know there's usually some mean reversion. Okay, let's talk about a couple of the areas in particular you like, which have almost nothing to do with each other and are wildly different. One of them, which is perhaps more surprising, is lithium, which has had a really tough year, has gone against the idea that, just buy that for the energy transition, you'll be fine.
Sure. And for folks who don't know us, we haven't owned a mining stock in 15 years probably.
Wow.
So what's going on here is that we think folks have just gotten way over pessimistic. EVs are the future. They may not be the future in the first half of 24, but they are coming, and they're building out charging stations, et cetera. So lithium demand will increase as we get towards the end of this decade. And the smaller companies will go bankrupt now because lithium prices are so low. This is akin to buying oil stocks, say, 3 years ago in the pandemic, where, remember, oil went negative for a day. And folks didn't want them. You didn't want to show them in your portfolio. So we think this is a great value play.
So Albemarle, which is often the most high-profile name that's cited, it's down 32% this year. Is that the way that you would play this?
Yes, I would play it that way. They're the largest producer in the world. You could argue that they're also the lowest-cost producer. It's hard to tell with some of the Chinese companies. But they will be around at the next upcycle. Now, when that's going to be, I'm not smart enough to tell. But I am thinking that the stock's down 65% from the highs of 18 months ago.
Wow.
And that's about as far as it's fallen in its 30-year history. It's done that 3 times. This is the 3rd time. We think it's a good entry price.
Didn't even realize it was a 30-year-old company that we've been in this business for that long.